Welcome to our presentation on unlocking the secrets of reversal trading. Today, we're going to dive into the exciting world of finance and explore how you can become a master of reversal techniques. Reversal trading is an essential skill for any trader looking to succeed in the market. It involves identifying trends and patterns that indicate a shift in the market's direction, allowing you to make profitable trades by buying low and selling high. But mastering this technique takes practice, patience, and a deep understanding of the market's psychology. Reversal trading is a strategy used by traders to identify potential changes in market trends. It involves analyzing price patterns and indicators to determine when a trend may be reversing, allowing traders to enter or exit positions at the right time. This technique is important in the world of finance because it allows traders to take advantage of market movements and potentially profit from them. By understanding reversal trading, traders can make informed decisions about their investments and minimize their risks. Reversal trading requires a unique mindset, one that is able to identify and act on opportunities that others might miss. This mindset involves a deep understanding of market psychology and the ability to remain calm and focused even in the face of uncertainty. One of the key psychological factors that influences reversal trading is fear. Fear can cause traders to make irrational decisions based on emotion rather than logic. Successful reversal traders are able to recognize when fear is driving their actions and take steps to overcome it. One of the most important techniques for mastering reversal trading is to identify key support and resistance levels. These levels can be identified by looking at historical price data and identifying areas where the price has previously bounced off or broken through a certain level. Another important technique is to use technical indicators to confirm your trading decisions. Indicators such as moving averages, MACD, and RSI can help you identify trends and momentum in the market, which can be useful in making trading decisions. One of the most common mistakes that traders make when attempting reversal trading is failing to properly identify the trend. It's important to understand that a reversal can only occur after a trend has been established, so traders need to be able to recognize when a trend is beginning to weaken or change direction. Another mistake that traders often make is failing to set stop-loss orders. Reversal trading can be very volatile, and it's important to have a plan in place to limit potential losses. Traders should always set stop-loss orders at appropriate levels to protect their investments. In conclusion, becoming a reversal trading master requires a combination of knowledge, discipline, and mindset. We've learned that reversal trading involves identifying trend reversals and profiting from them, and that psychology plays a crucial role in successful trading. To become a reversal trading master, you must first develop a deep understanding of the markets and the various indicators and techniques used in reversal trading. You must also cultivate discipline and patience, avoiding common mistakes such as overtrading and failing to cut losses. Finally, you must adopt a growth mindset, constantly seeking to improve your skills and adapt to changing market conditions. Remember, becoming a reversal trading master is not easy, but with dedication and hard work, it's within your reach. Take the next steps by practicing your skills, seeking out mentors and resources, and developing a solid trading plan. With persistence and a willingness to learn, you too can become a successful reversal trader. Thanks for watching. Like and subscribe, and we will catch you on the next one.